Hi, in this short video, we are talking about borrowing and interest and how accrual accounting impacts this all good stuff from chapter 2. So I love to kind of have a picture of my head when I go through examples. So let's say we have this dog grooming company. We're going to look at our financial statements, specifically our income statement for profitability. And that's really where accrual accounting concepts come in, because on our income statement, we have revenue and expenses. And because there's a cost to borrowing, there is an expense, and we have to recognize that expense when we actually use things up. And we're going to be using up time with money, because that's basically what interest is. So when we use the money to run our business, boom, that's when we have to recognize that expense. We also have the time period principle that shows us that we need to divide our financial information in periods of time. And this really becomes important. So let's go with an example. So let's say our dog grooming company, we want to buy some new bathtubs for our pooches. So on October 1st of this year, we plan on taking a loan of $6,000. It's an 8% loan where interest and principal need to be paid back in 10 months. So we think in 10 months, we'll have enough money to pay back the $6,000 and any interest. So let's go to the bank, and you notice the banker's a cat. Well, we're talking about dogs. Yeah, you got to watch out for those cats. Anyway, so he's given us a decent interest rate. But the first thing you got to be aware of when you see these questions is interest rates are always annual rates. Doesn't matter how long the loan is for. The interest rate is always going to be for 12 months. It doesn't matter if you get a mortgage for the next 20 years. They're going to quote you an interest rate per year. Or if you take out a loan for 1 month, the interest rate they give you will actually be a 12-month rate. So if we take the $6,000 times it by 8%, $480, that's the actual amount for an entire year. But because we're only taking this loan for 10 months, the only amount of interest we'll ultimately need to pay is $400. So the $6,000 times 8%, which gives us $480, and then we'll take that $480 times 10 out of 12 months, because we're using it 10 out of 12 months, and boom, $400. So now the time period principle kicks in, because we're going to borrow this sucker October 1st. But then, of course, we're going to report December 31st, because that's going to be our year end. So we're going to need to do an adjusting entry to make sure we've collected all of the interest that's happened in 2022. So if we're at December 31st, 2022, we're going to look back in time and see, we've borrowed this $6,000. We've used it October, November, December, 3 months. So the cost of using that money in 2022 is the $480 times 3 out of 12 months, or $120. If we think about 2023, we're going to use that January, February, March, April, May, June, July, or 7 months, and then pay it back, August 1st right here. Well, the cost of using it for 7 months is $280. So if you put those two amounts together, it comes out to that $400. So we're basically splitting the total cost between these two time periods. All right. So let's walk through how we would capture this information. So October 1st, we are going to borrow $6,000. That means our cash is going up by $6,000, but so are our liabilities going up by $6,000. So if we think about our statement of cash flows, this is a cash inflow of $6,000, and it's a financing activity. Woo, woo! We got the money. Now, next thing we'll have to worry about for this particular loan is December 31st. When we make those adjusting entries, when we make sure that our income statement and balance sheet are super, super correct. So we have to show everything we've used on our income statement. And remember, we calculated the interest expense at $120. So we'll need to update that income statement to show the cost of using the money during the time period, during 2022. We're also going to show, oh darn, hey, we owe $120 at this point in time. We don't need to pay it yet. We're not going to pay it back until August, but damn, we've been using the money. We definitely owe that interest. Now, that entry is absolutely going to decrease our net income because it's an expense, and that's okay. And that's going to get reported within this 2020 new year. So, we're going to report that expense in our income statement, and then we're going to do our closing entries and transfer that $120 into retained earnings. So it first gets reported and then ultimately goes into our retained earnings. So at the end of the day, our accounting equation is going to be in balance. But look at this. We didn't touch cash. So it's not going to be on our cash flow statement if no cash flowed. So we don't have to worry about that statement. Woot, woot. So remember, our expense and our our expense account would be closed. All our revenue, expense, and dividend accounts are closed. Our liability accounts, they stay open. They are permanent accounts because we still owe these amounts, even though we're traveling in to 2023. So August 1st, 2023, holy smokes. Now we've been using that money for the last 7 months before, since we've done anything with this loan. So the cost of using it for 7 months is $280. We're in a new year, so for this year, we're going to show expenses of $280, which will ultimately bring down our net income for this particular year. And that, of course, that $280 will get transferred in to our retained earnings account, keeping our accounting equation in balance ultimately. Now it's time to pay this sucker off. So at this time, we got to pay both the $6,000 and the $400 in interest. So I'll subtract that out of my cash account. Then I'm also going to subtract that out of my notes payable and $400 out of my interest payable. So ultimately, when I do that for these accounts, they'll show a zero balance at this point because I've got those liabilities now paid off. They are done. I'm done paying them. So I want to show a zero balance in those accounts. I'm just not going to total this account because you would hope we'd get more cash in, so we could pay that for $6,400. Now, that's money coming out of the bank. If it hits our cash account, oh yes, it would definitely hit our statement of cash flows for this particular year. And again, that would be a cash outflow. Money's going out, but it would still be reported in our financing activities. All right, hope this video helps. Please give a try to the next practice question in Connect. Thanks and have a great day.